Hello, and welcome back to Reflections on Investing with the Cornell Capital Group. Last time we had quite an extended session on discount rates. And what I'd like to do today is show you how important those are for understanding investment strategies in the future of the stock market. So let me review where we ended last time. I said that finance research, including by two Nobel laureates, Bob Shiller and Gene Fama, had pretty conclusively showed that if stock prices are high relative to a measure of cash flow, such as earnings, for example, that there are two possible explanations. And here they are. Either investors are expecting faster earnings growth, or they're willing to accept lower future expected returns. But which is it? There's quite a difference. You'd certainly like to know for your own investing strategy. Well, where are we right now? And for the measure of price to earnings, I'm going to use the Shiller-Cape ratio shown here, which we discussed in an earlier Reflections, and I showed you exactly how Professor Shiller calculates that. So where we are now is shown by the red line, and you can see that it's well above the historical average. So that suggests that going forward, investors are either expecting faster earnings growth or lower expected returns. But which? Well, in another previous Reflections, we talked about earnings. And I noted that earnings are now particularly high. And in addition, GDP growth has slowed. That combination makes it very unlikely that we're going to see faster earnings growth in the next 5 to 10 years than we've seen in the last 5 to 10. So to explain the high level of the Cape ratio, it must be lower expected future returns. So as an investor, how do you react to that? Well, again, it depends on why or how the returns are going to be lower. And there are actually two polar cases here. One is, and this has happened on a number of occasions, in 2001, 2008, for example, you have a crash followed by normal expected returns. The other alternative is what I call a slow slog to nowhere, where price appreciation slows to a crawl so that eventually earnings can grow relative to prices and bring the ratios back into a more normal range. But you can see that depending on which of the two you think is going to happen, you may invest very differently. If you're really concerned about a crash in the relatively near future, you're going to want to do things like sell stocks, move to cash, buy put options to insure against the decline, those type of things. However, if you do that and it turns out it's a slow slog to nowhere, then the cash is going to earn even less than the market. And if you buy put options and prices creep up, you're going to lose you're not going to get anything from the put option, so you'll lose money there, and that will reduce the returns even further. So at the Cornell Capital Group, what we're trying to do for our clients right now is make a decision on which of these two things we think is more likely. Are we concerned about a crash or a slow slog to nowhere? And we're trying to orient our client portfolios so that they're as protected as they can be without too much compromising future returns. So, to reiterate and review, when you see a high ratio of price to cash flow, it means either faster earnings growth or lower expected returns. If it's lower expected returns, that may indicate a crash followed by normal expected returns or a slow slog to nowhere. So I think this shows the importance of really understanding the role of discount rates in determining the future expected returns that investors can get and how they should respond to that. If you have questions about this, I know it's a big subject, get in touch with the Cornell Capital Group. We love to talk to potential clients. This has been Reflections on Investing. Until next time, thanks for joining us.